Welcome to this episode of Founded in Tech. I am your host, Mark Eckerle, and today's show is part of our Tech Tips series where I sat down with Ryan Babiak to talk about tax reporting for cryptocurrencies and virtual currencies and other digital assets. In today's episode, we discuss how to properly report virtual currencies on your tax forms for 2020, how the IRS is currently evaluating these digital assets, and then various tips regarding mining, staking income, hard forks, and much more. This conversation was very insightful when talking with Ryan, with a lot of great takeaways. I hope you enjoyed as well. Hello, everyone. Welcome to today's show. Today, I'm joined by a recurring guest, Ryan Babiak, to take a dive into cryptocurrency tax reporting. Hey, Ryan, how you doing today?
What's going on, Mark? The end of a long week, but I'm still in it, and I'm showing my Withum team colors for anybody that actually watches and not listen only.
Awesome. So for a refresher, why don't you give our listeners a quick intro to your background and what you do here with them?
Sure. So I am a tax partner in our technology and emerging growth group. Been doing tax work for a little over a dozen years. I came to Withum through a merger about 6.5 years ago. There was a really big need to support the growth of our tech group here. So I dove right into that. And then I would say probably 2.5 years ago, coinciding maybe with the ICO craze, there was we had a lot of companies in the blockchain space, and they had some very technical questions. So we had to really get a team, including yourself, of course, right, Mark, to start understanding and providing really valuable advice to these people in a technology that is far surpassing the regulatory infrastructure around it.
Yep. This is definitely a topic that is near and dear to my heart, as I work closely with cryptocurrencies and digital assets in various aspects. So I think this episode will be very important for a lot of listeners, just based on the fact that 2020 was a pretty big year, if you think about it from just strictly a pricing perspective, right?
Yeah.
With Bitcoin and other digital assets reaching all-time highs, I think there's definitely going to be more of a need to reporting this on your tax forms. So jumping right into it, 2019 was the first year that the IRS had a specific question. I believe it was on Schedule 1, where it did something to the effect of, at any point in time during the year, did you receive, buy, sell, transact with virtual currencies? And ironically enough, I believe in 2020, they're moving that to the front page of 1040.
Page 1, yep, page 1. It'll be right front and center, absolutely.
Front and center for one of the first questions. So they're definitely putting this as a priority. And I think it's going to be important for a lot of people to report this year, as they will be cracking down a lot harder than they have in the past. So jumping right into it, why don't you give our listeners a quick overview of what digital currencies, or how the IRS calls it virtual currencies, and what these look like, and how are these reported on your tax forms?
Yeah, so 6 years ago, 2014, there was in the community very well IRS notice that was issued that didn't say a whole lot other than the IRS was treating virtual currency as property. So right off the bat, they had a position, right or wrong, whether it really fits the intent of how people transact in crypto. The answer was easy. You think of it no different than you would anything other than cash. Stock is most commonly the example I like to use. But we fast forward a bit, and we've talked about this too. We've given these presentations. I've done a bunch of tax presentations, and for the longest time, I could just copy and paste last year's presentation with some updates, what's going on in the news. And then at the end of 2019, we finally got some guidance back from the IRS. They issued a ruling on how hard forks and airdrops are taxed. But more importantly, I think, is they developed a series of FAQs that's published on their website. I think there's 48 or 49 of them that lay out a bunch of common situations and how to treat the transaction, because it's not as simple as just saying crypto's property and we're done. I mean, there's a lot of interpretation around that. And I think for the last 6 years, we've had the guidance around how to guide your clients, how to guide companies has come from attorneys and CPAs and the industry just talking amongst itself in an agreement and how we all practice things commonly.
Mm-hmm. Yeah, exactly. And it's the best example, like you said, the analogy here is stocks, right? And when if you buy and sell stocks, you get a 1099B from your broker, and it's pretty straightforward to map that out as far as your tax reporting. In this case, it may be a little bit different because you're not necessarily getting those tax forms from various exchanges where you're buying and selling. So for newcomers into this space, why don't you break down, so we know it's treated as property, what does the tax implications look like and how is it treated? So the difference between capital gains tax, what does short-term versus long-term mean? And then there is also the option of, depending on how you use your assets, it could be treated as ordinary income, correct?
Yep. First and foremost, because crypto tokens, coins, because they're property, anytime there is an exchange, even if that's just exchanging from one coin to another, it is a taxable transaction. And that becomes very difficult with capital gains and losses, because on a personal perspective, like you or me, there's a limitation on how much you can deduct in net capital losses in any 1 year. It's only $3,000. It carries over forever, but there's some planning that has to happen with that. And I think sometimes people who aren't knowledgeable in the tax consequences may not know that. And then, if it's held through a corporation, there is no net capital loss. It just, you carries for 5 years, you could lose the benefit. And crypto is such a volatile area that value is always going up and down. Like you said, we hit all-time highs. We've had a little bit of a pullback, and that's just something I think people have a very difficult time tracking. And so if I'm using crypto as its intention being a capital asset, I'm using it to gain wealth. I'm using it as treating it like a stock or a security. When I get rid of it, it'll receive capital gains treatment, which is nice because if you hold it for over a year, the tax rates are reduced from ordinary income like you and I would have on our compensation. Mm-hmm. Now, on the other side of this, and this came up quite a bit when the ICO craze was going on, I had companies that were issuing Bitcoin for as a form of salary or compensation. So in that regard, that income is going to be ordinary, no different than you getting cash for performing your services to Withum. The challenge again is always really, it's been around record keeping.
Okay, and so you mentioned certain people that may not be savvy in this space from a tax perspective. Can you quickly go into again, certain planning procedures that may be around year end, like for example, wash sales is a very hot topic where you can kind of sell at year end and then rebuy in January just based on certain price factors to carry forward that loss. Can you quickly go into what a wash sale is and
and wash sales, I think I guarantee you they're not being reported correctly and consistently in this space. Mm-hmm. Where if you're working with a broker on securities, it's built into their platform functionality, right? When they issued you a 1099 at the end of the year. But a wash sale, it's effectively, without getting too technical, you are selling property at a loss, recognizing the loss, and then you're replacing it within a short time frame so that economically you're no worse off than you were before, and you just created a paper loss for yourself. So what would happen is that wash sale would get ignored, and you would update the basis of the new security. And it's for people who are high volume traders. Mm-hmm. I don't know how you ever track that without it being controlled by a proper broker or exchange that has IRS reporting requirements. Mm-hmm. And I'm sure we'll go into it in a little bit, but there is right now no requirement for a crypto exchange to issue 1099s, and I think we'll talk about it in a little bit, but it's definitely an area the IRS is going to said they're going to start focusing on. They've got a lot going on, right? Unprecedented year, a lot going on. Who knows? It took 6 years to get from the first IRS notice to another update at the end of 2019. So it's gonna take some time.
Yeah, one step at a time, right? We're slowly moving in the right direction.
Slowly, yes.
But transitioning, it's the perfect segue from wash sales to figuring out, I guess, certain realized gains, right? So when you're calculating your realized gains and for your tax returns and trying to figure out what that looks like, what is the, I guess from IRS perspectives, what are the approved methods of calculating those realized gains from your cost basis as far as like acceptable methods for your cost basis?
Well, people want the best of all worlds here and minimizing their tax gain, right? So there's a couple different ways you can look at how you sell your crypto. You could have a last in, first out approach where you sell what you acquired most recently. You would expect If something's appreciating over time, that would have a higher basis, right? And if you sell something at a higher basis, you're going to have a lower gain on that. Or if you use a first in, first out method, that would result, you would think, in the worst case scenario. Again, this is in most cases, given how volatile the crypto industry can be, that's not a guarantee. And then the one that I think most people want to have is specific identification, where you can actually say, okay, I've got 5 lots of Bitcoin, I'm going to sell this specific lot. And that was one of the questions that was asked of the IRS to opine on, is what can we use? And the answer is, FIFO, first in, first out, that's the default method that you can use. But if you are able to provide support, or at least, if you're ever asked for it, the information, you can use this by specific identification method. And a few things have to happen. I mean, you've got to document, the unique digital identifier, like private and public keys. You need to show the date and time that each lot was acquired. You need to be able to show the basis, right, which is basically, in simplest terms, what you paid for it, and the fair market value, right? And then the same is true of when you sell it. So you need all the pieces that are there, similar to what you would do if you had your own equity brokerage account and you sell shares in a public company.
Yeah, and I think, like you said, I think specific identification is probably the most preferred method, so people can really have a hands-on focus of, or hands-on account of what their tax basis would be. But it is pretty burdensome, right? You got to go through that analysis of really tracking your lots, your buys, your sells, and allocating those transactions across the board. So it's a little more hands-on, as far as FIFO can be a pretty simple formula-driven calculation.
Yeah, agreed. Yep.
So transitioning over to another kind of hot topic in this space, where there's a bunch of different alternative coins out there, or alt tokens, as a lot of people call them. What would that look like from a tax perspective if you receive those tokens via airdrop or hard fork, a change in the protocol from Bitcoin to Bitcoin Cash, which happened back in 2017? And then alternatively, what does mining income or staking income look like from a tax perspective, and how should individuals treat those rewards, if you will, the new assets?
Sure. So hard forks, airdrops were covered under the ruling that came out at the end of 2019, and it all comes down to one of the most simple foundations of gross income in the tax law, and that's an accretion to wealth. And if a hard fork by and of itself, just by changing the protocol of you don't have anything more than you had the day before. So there's no accretion to wealth. It's not a taxable event. Whereas an airdrop typically would result in that accretion to wealth and would be taxable. And mining, is in most cases, it's really you're getting paid in the form of crypto for services rendered to the blockchain, right? So in almost all scenarios, the airdrop and the mining is not going to be a capital gain. It's going to be taxed as ordinary income, as if it's in return for the effort of your services.
Gotcha. And then how would donating crypto, right? If I donate cryptocurrency assets, there's a bunch of not-for-profits out there that are accepting this now as an alternative to cash. So what would that look like, and how is that reported on your tax return as well? And
sure, I was going to say
benefit as opposed to donating from crypto as opposed to cash, or is there a way to finagle that around year end?
There is. Like that? Yeah, there is. There's you said it when you started the question, was that the foundation, the recognized 501c3 charity, right? They have to be able to accept crypto first. So assuming that hurdle has been passed and you can donate Bitcoin or ETH, right? Your donation is equal to the fair value of what that is going to be at the point that you make the donation. There are rules. I'm not going to get into them right now, though, about how to determine value and whether you need an appraiser over a certain threshold. But the famous catch-all term is consult your tax advisor, right, about all that stuff. But pretty much you'll get a potential deduction for the fair value of what you donate. There are limitations on a personal level, which is I find probably the most common scenario that we come across, as to a certain percentage of your gross income that you can deduct. There are splits between how much you can do in cash and how much you can do in property. And on the other side, we take the donation, we come up with the value, we put it into a bucket off to the side. It's part of what are called itemized deductions. So you need to factor in any other itemized deduction that you have on your tax return, such as state income tax or property taxes, interest on your mortgage if you're a homeowner, and a few other things. But if that amount, when they're all aggregated together, exceed what is called the standard deduction, which is the government's freebie deduction off the top of your income, and that number is indexed every year. I can't remember where we're indexed at this year, but let's somewhere in the neighborhood, I believe, of $13,000 on an individual and double that for a married couple. If you're over that amount, and your aggregation of that bucket, then you take that deduction instead of the standard deduction. So you need to understand your tax profile a bit to know, obviously, if you want to be charitable, absolutely great. But if you're doing it also with the tax planning in mind, you've got to understand what your tax profile looks like.
To not go too far down it, you mentioned, and I'm not a tax professional by no means, so I'm just here picking your brain basically.
You're enough to be dangerous, Mark. I know that.
That's my saying right there. If I'm an individual and I have reached my cap for cash donations, right? I think you said there's a cash profile and then a property profile.
Mm-hmm.
If I have reached my cap from a cash perspective and I want to try and increase my threshold above that standard deduction, can I instead donate crypto, convert cash on the spot, donate crypto, and increase my standard deduction or my itemized deduction to get more of a benefit on my tax return?
If you were going to, the only thing that you'd have to consider is what's the tax gain or loss on that. So you could do that and convert into cash so that your threshold on the cash donation is higher, but you have to consider what the tax gain and loss looks like on that conversion.
Gotcha. Okay. Because I'm just trying to think of an alternative method. Just again, all about tax planning.
Oh
right?
Yeah, I agree. Yeah, you've got to, and it comes back to me being the most important part of this is just record keeping and understanding what you have and how you got it.
Yeah, and definitely consult your tax professional as you're going through this process to really know your tax profile, right? Because not everyone tracks that stuff on a regular basis, so it's good to know.
Mm-hmm.
So jumping right with the IRS perspective, right? The crackdown that we alluded to earlier, they're going to start looking at this with more of a narrow focus, moving the question from Schedule 1 to the front of 1040.
Mm-hmm.
What they started doing last summer, the summer of 2019, was issuing some letters, right? And I think they started doing that again this past summer. What does that, what are those 3 letters? What are the consequences? What does an individual have to be on the lookout for? Should they be worried if they receive those in the mail?
Mm-hmm.
And what are the next steps or actions to take?
So there's 4 divisions of the IRS. I'm not going to get into what they all are, but the large business and international division was running up this compliance campaign, and they actually started it in 2018. But I think in our experience, we only started to see the notices come in 2019 and moving forward. And what they are is, I'll go through the letters, because if you have one, again, call your tax advisor, right? So it's the common letters are 6174, 6174A, and then a 6173. And there's different levels of urgency attached to these. So effectively what they are saying is, in some way, shape, or form, from lowest level of urgency to most urgent, is the 6174 is just an inquisitive information letter to say, the IRS believes we're writing you because we think you may have 1 or more accounts containing virtual currency, and you may not know the proper way to report these transactions. They don't know what the amounts are. They don't know what the liability is, if there even is a liability. And at the bottom of the letter, it does say you don't need to respond to this letter. So I'm sure people who've received these are just folded up, put in their pocket.
That's the best letter to get.
Yeah, right? That's the best letter to get. Yes, the one that's heightened a little bit beyond that is the 6174A. All that says it's very similar. Other than that, and by the way, they don't tell you what additional information they may have that's attached to your name or your social security number or your employer identification number. This one is very similar, but it says you don't need to respond to this letter. However, we may send additional correspondence about potential enforcement in the future. So that's a keep checking your mailbox letter. And then the last one here is the 6173, and that is where the IRS knows you've got accounts, and you need to just respond that a recognition that you've received the letter, explain the actions that if you are compliant, explain the actions you've taken to become compliant. Again, it's not a notice that has a liability. What they may do, though, if you don't get back to them by a response date, is they may refer you for an audit, and you may get a letter in the mail that says we're going to audit you.
Okay. So the first. Oh, go ahead. Sorry.
Go ahead. No, go ahead. Go ahead.
No, I was going to say just a quick summary. So the first one is there's no action, and that's explicitly stated on the letter.
Correct.
The second one is they may be following up,
but there's no action at the current moment in time. Yep.
And then the third one is you do have to respond. There is a response required.
If you don't respond, we may audit you. Yeah.
Okay. Understood.
Yep.
Yeah.
There's even one more part of this too, which is not related to the IRS thinking that you're I don't want to say hiding assets, but maybe not understanding your obligations to report them. We started talking about too how people are need to be diligent about their record track, keeping track of their holdings. I think people may realize that they're not getting 1099s from certain exchanges, right? And we work with some exchanges too in this capacity. And what's your reporting obligation to your customers? And because exchanges are not considered like a broker or dealer of securities under the eyes of the IRS at the current moment in time, they're not obligated to issue a 1099-B, which would have your typical, think of your own brokerage statement where you hold equities that would have everything under the sun that you need on it, right? What you hold, how long you hold, what you acquire for, how long you've held it, what's unrealized, what's realized, what goes on your tax return. Is it long-term gain or short-term gain or loss? There's even a box in there to say that the IRS the exchange or broker has or has not provided the basis information to the IRS. Crypto exchanges are not required to do this. And quite honestly, because of the nature of the ecosystem and transferring between wallets and exchanges and people, it's very difficult, if maybe not impossible right now, to make sure that reporting that basis information, right, what you bought for so you can determine the gain or loss, I think it's very difficult, not impossible, for them to report that accurately. So what a couple exchanges were doing is issuing 1099-Ks as what are considered for third-party settlement organizations. The problem with this is they only report the gross amount of transactions that have happened with your account during the year. It includes nothing about gains, losses, or tax bases. The IRS gets a copy of this notice and they may view it and say like, hey, Mark had $1 million of gross transactions pass through XYZ exchange this year. You don't report that $1 million on your tax return. You get a notice, a civil penalty notice, CP 2000, that basically says there's a mismatch here. We expected to see this, you reported this, and now you're under the microscope. Now you've got to explain what happened. And it's almost as if you're under audit anyway, because you've got to go through all your records to be able to confirm why you didn't report the number on that notice. It's I think becoming a huge issue. And I think a lot of exchanges have scaled back, knowing that they took a closer look. They weren't required to file these either. So I think we're going to run into a year maybe where we don't have a lot of reporting at all coming to the IRS from these exchanges.
Yeah, I think you really hit the nail on the head there, where individuals wanted exchanges to be more compliant, like their broker, like their stockbrokers, and get these 1099-Bs. And so they started issuing some 1099-Bs, 1099-Ks, and like you alluded to earlier, I think PayPal now, who's recently entered the space, is issuing 1099-Ks, and I think a lot of people should be prepared to receive those CP 2000 letters.
Yeah.
But it's not necessarily that you should be alarmed of, because it just might be a possible inaccuracy in reporting, right? Is that correct? Right.
It is. It's you have to explain it. We've seen it with just regular operating companies that may act as a facilitator of a transaction. they take a payment on behalf of somebody, they take a cut for whatever their service is, and then they share it on. Think of like like Grubhub or a DoorDash might be a good example, where they're taking your full payment and then passing the piece on to a restaurant, right? So they're issuing these 1099Ks, or should be. And the person who's receiving them, it's not matching up necessarily to, or sorry, the DoorDash would get the 1099K, but that's not all their revenue. They've got to explain then to the IRS, if they got a notice, that it's a pass-through. Yes, I collected this. My revenue is only this piece, and I passed the rest of it on to to the merchant.
Yeah,
similar scenario.
And it's definitely important for people to realize that, like, if you're receiving a letter from the IRS, you don't necessarily have to be alarmed, right? It's just kind of, you have to explain the situation to them, and bring them up to speed of what the transactions and what actually happened.
So it still makes you nervous. You got a notice in the mail, and maybe you don't know what your tax position is, because you just don't know how tax of crypto works.
Yeah.
So maybe getting yourself into a situation, and even if there's not some large exposure out there, now what you've got to do is you've got to get people involved. Whether you've got to, maybe you get an attorney involved, maybe you get an accountant involved. That still takes up time and effort in your day, and it just, it's an area that I know the IRS has said they will be providing guidance on. My guess is that sooner or later exchanges will be required to issue 1099Bs, which I think is, people that maybe don't want to disclose all their assets, they're probably not going to be thrilled about, but it'll make a lot of problems go away for a customer. It'll create a whole heck of a lot of problems for the exchange to make sure that they can report this stuff accurately.
Yeah, but at the end of the day, if the IRS is looking to have more people report it, I think that would be the best method, and to receive those statements, as opposed to everyone kind of have to do it on their own.
Yeah.
So that's definitely, I fully on board with that, and we covered a lot here today. So I like to wrap up all of our conversations with all of our guests with one recommendation or tidbit of information that you would like to pass along. You've been working in this space for a while. You've seen a lot of different things with various experiences in your time. So what is one thing that you've come across most often that you've encountered with various individuals or companies that they wish they had known in hindsight, right? Like, wish they had previously known and experienced earlier on. So is there anything that you could pass along for people to kind of be proactively thinking about?
Yeah, I think it's really comes down to organization and record keeping. And I don't want to keep saying that, but it really is true. It's and this is something I've repeated too in any type of podcast or conversation or presentation environment, is that we're at a point where we've got this fantastic technology of blockchain, and it always takes regulators time to catch up to technology. You and I know that, right? We work in technology every day. We totally understand that. But people trying to, the infrastructure is not there to support it from both a financial, accounting, in many scenarios, tax perspective. So people are resorting to spreadsheets. And I love spreadsheets, just as much as the next person. But I think if people are heavy traders and they've got tens of thousands of transactions, that's a heck of a lot of time to have to manage your tax compliance, whether it's yourself or it's your tax account, right? It's going to cost you money in compliance fees. It's difficult. There are software companies out there that provide great software. The challenge still is that the data in is data out is only as good as the data in, and if the data in is coming from multiple places, it's very difficult to get the whole picture. So I think it's organization, and if there's a way to try to limit where you're holding everything and get things kind of reported under one roof, right? Similar to how you and I probably do, like where we budget, whether you use like mint.com, right? You can pull in all your credit cards and all your brokerage accounts so you can see everything together. If there's a way to think about that and get that done, that'll definitely help out in the long run.
Yeah, and compiling that data, like you said, we're in such an emerging technology. We're working with such a new asset class.
Mm-hmm.
And it feels like I don't want to say going backwards, but we're staying stagnant working with Excel spreadsheets, right?
Yeah.
And you alluded to, there are softwares out there. So for a lot of the active traders in the space, if you have a lot of transactions, there is a way to aggregate that data. But you hit the nail on the head where it's the output is only as good as the input. right? So you can have your assets in multiple places, but it may be a little bit time consuming to compile that data, depending on the various places that it's stored.
Yeah, absolutely.
Awesome. Well, that wraps up our discussion today for reporting cryptocurrencies on your tax forms. Thank you, Ryan, for joining me. If you'd like to learn more, please visit withum.com for more information. We have a specific digital currency and blockchain technology landing page, so please visit that, and looking forward to talking again down the road.
Thanks, Mark.
Thank you for tuning in. If you liked it and want to hear more, you can follow us and subscribe, and we'll see you next time on Founded in Tech.